Cross-border financial statement analysis translates raw accounting grammar into actionable strategic reality. We are examining two multinational giants for this comparative valuation: Microsoft, based in the United States, and GlaxoSmithKline, headquartered in the United Kingdom. This chart shows return on equity for both firms in 2022. Return on equity, or ROE, measures how efficiently a company uses shareholder capital to generate profits. Microsoft posts a highly respectable 43%, but GlaxoSmithKline dwarfs it as its return explodes off the top of the scale at 154%. Despite this massive gap in profitability, empirical analysis dictates an advocate for rating on the company with a 43% return and an advocate against rating on the 154% return. Evaluating financial metrics, like profitability, in total isolation is a fatal analytical error. Financial health exists within an interconnected matrix where liquidity, gearing, and unvarnished cash flow define the actual reality of a firm's profitability. Before any ratio analysis can begin, analysts must normalize the opposing regulatory frameworks governing the two firms. Microsoft's reporting environment is anchored by strict mandates from the Securities and Exchange Commission, or SEC, and the prescriptive rules of US GAAP. GAAP stands for Generally Accepted Accounting Principles, a standard set of accounting rules used in the United States. Contrast this with GlaxoSmithKline. Their environment is governed by UK companies' house filings and the more principle-based IFRS. IFRS is the International Financial Reporting Standards, a globally recognized framework for financial statements. This diagram illustrates the traditional US GAAP structure of a balance sheet. The equation is framed as assets equals liabilities plus equity. The UK IFRS model reconfigures this exact same data to isolate net worth, presenting the equation as assets minus liabilities equals equity. On the income statement, IFRS allows expenses to be classified either by their nature, such as raw wages and depreciation, or by their function, like cost of sales and administrative expenses. Without understanding how a company chooses to group its expenses, comparing operational efficiency across international borders becomes analytically flawed. We now turn to the Microsoft case study spanning 2020 to 2022. This data provides a masterclass in capital allocation and operational efficiency. This chart tracks Microsoft's surging operational profitability. Earnings before interest and taxes, or EBIT, grew from roughly $52 billion to over $83 billion. Return on investment also climbs steadily over this period to nearly 23%, showing increasing efficiency. The critical analytical test for any expansion is whether this growth is being artificially fueled by dangerous levels of external debt. Microsoft's gearing ratio actually dropped significantly, from 48% down to 38% during this massive growth phase. The gearing ratio measures the extent to which a company's operations are funded by external debt versus equity. This deleveraging trend is corroborated by their total debt-to-equity ratio, which dropped from 155% to 119%. Microsoft also maintains an internal growth rate averaging 28%, the highest level of growth a company can achieve without external financial borrowing. This means Microsoft is capable of funding its massive operational expansion entirely through its own internally generated funds. This internal funding capability is validated by a 47% growth in cash flow from operating activities. Microsoft represents a self-sustaining financial loop. It possesses a fortress balance sheet where high profitability is insulated by minimal external risk and abundant liquidity. The GlaxoSmithKline case study presents a trajectory that at first glance appears to eclipse industry norms. This diagram breaks down the components driving GSK's staggering 154% return on equity using a DuPont analysis, which decomposes ROE into operational efficiency, asset use, and financial leverage. The company exhibits genuine operational strengths, with highly efficient daily operations. But we must pivot the analysis to the liquidity metrics to see if the company can actually survive short-term shocks. This chart reveals a fatal flaw. GSK's current, acid test, and cash ratios consistently flatline below the critical 1.0 threshold. A ratio below 1.0 means GSK lacks the capacity to cover its immediate short-term obligations without liquidating assets or seeking external financing. If liquidity is this poor, how is the return on equity mathematically reaching 154%? This graphic illustrates the equity multiplier effect in action. Total debt to equity exploded to an alarming 496% in 2022. This massive leverage artificially inflates the ROE. The company is generating returns, but doing so on a highly leveraged and fragile foundation. The illusion of the high return on equity contrasts with a declining trend in cash flow from operating activities. GSK's profitability is a debt mirage. Operational efficiency is entirely overshadowed by severe liquidity constraints and dangerously high leverage, rendering it a speculative risk. The cash flow statement is the ultimate arbiter of corporate reality, immune to accrual distortions, non-cash artifacts, and accounting loopholes. This comparative waterfall chart shows the raw cash generation power of the two firms. Microsoft's operating cash flow accelerates upward, while GlaxoSmithKline strains downward. This leads to the final investment directive for Microsoft, a definitive Advocate 4 acquisition rating. This rating is justified by its optimal matrix of robust profitability, a declining reliance on external debt, and massive cash generation. The final investment directive for GlaxoSmithKline is a definitive Advocate Against rating. No amount of operational efficiency can justify acquiring a firm with such acute liquidity constraints and extreme leverage. Profitability ratios are theoretical promises until they are validated by liquidity, contextualized by debt peering, and ultimately realized as cold, hard cash flow.